Have you ever wondered how people make money from the stock market? Maybe you've heard of friends or family members talking about investing in stocks, but you don't really understand what it's all about. The stock market can seem intimidating, especially if you're new to it, but doesn't have to be. In today's video, I'm breaking down the basics of stock market investing for beginners. If you're new to investing and want to understand how the stock market works, this guide is for you. Stay until the end because we'll reveal the most important piece of advice for beginners that could save you time, stress, and even money when you start your investing journey. Let's dive in and demystify the world of stocks together. Tip 10. Understand what the stock market is and how it works. Before jumping into the world of investing, it's important to first understand the stock market itself. The stock market is essentially a platform where buyers and sellers come together to trade shares of companies. Think of it as a marketplace where you can buy a small piece of ownership in businesses. When you purchase stock in a company, you're buying a share of that company's ownership. Companies sell shares to raise money, and in return, shareholders may earn profits through dividends or by selling their shares at a higher price than they bought them. The two main stock exchanges in the US are the New York Stock Exchange and the NASDAQ. These exchanges list thousands of publicly traded companies, and they facilitate the buying and selling of their stocks. Understanding this basic concept helps you grasp the essence of investing. When you invest in the stock market, you're investing in the future of companies you believe in and have faith in their growth. Tip 9. Learn about different types of stocks. Not all stocks are created equal. There are various types of stocks you can invest in, and understanding them can help you make better decisions. The two main types of stocks are common stocks and preferred stocks. Common stocks are the most common type of stock that people buy. When you purchase common stock, you get voting rights at the company's annual meetings, and you may receive dividends if the company decides to pay them. However, common stockholders are last in line if the company goes bankrupt, meaning they may not get anything if the company's assets are liquidated. On the other hand, preferred stocks don't typically give voting rights, but they provide a more stable income through dividends. Preferred stockholders have a higher claim on assets in case of bankruptcy, making it a safer investment, but they don't have the same upside potential as common stockholders. Knowing the differences between these two types of stocks can help you decide what fits your financial goals and risk tolerance. Tip 8. Understand how to buy and sell stocks. Once you know what the stock market is and what types of stocks are available, the next step is learning how to actually buy and sell stocks. The most common way to buy stocks is through a brokerage account. A brokerage is an intermediary between you and the stock exchange. It allows you to place orders to buy and sell stocks. There are two main types of brokerages: full-service brokers and discount brokers. Full-service brokers offer personalized advice and research, but they usually charge higher fees. Discount brokers like Robinhood, eTrade, and TD Ameritrade allow you to trade stocks at a lower cost, but you're responsible for making your own investment decisions. When you're ready to buy stocks, you'll place an order through your broker. There are a few different types of orders you can place. Asterisk market order. This is the most straightforward order. When you place a market order, you're buying or selling stocks at the current market price. Asterisk limit order. This order lets you set a specific price at which you want to buy or sell a stock. If the stock reaches that price, your order will be executed. As a beginner, it's important to understand these basic order types so you can execute your trades properly and understand the cost implications of each. Over time, as you become more experienced, you may use more advanced order types like stop-loss orders or trailing stops. Tip 7. Know the risks of investing in stocks. One of the most important things to understand when it comes to stock market investing is that it's not a guaranteed way to make money. While the stock market has historically provided strong returns over the long term, there are always risks involved. The value of stocks can go up and down based on market conditions, company performance, and economic factors. As a beginner, it's crucial to understand the risks involved in investing in stocks. Stock prices can be influenced by a variety of factors, and being aware of these can help you make more informed decisions. Economic changes such as recessions, inflation, or shifts in interest rates can significantly impact stock prices across the market. Additionally, the performance of individual companies plays a major role. If a company underperforms or faces challenges, its stock value may decline. Tip 6. The importance of diversification. When it comes to stock market investing, diversification is one of the most important strategies to protect yourself from risk. Diversification means spreading your investments across a variety of stocks or other assets, rather than putting all your money into one company or sector. For example, if you invest all your money in a single stock and that company faces financial trouble, your entire investment could be at risk. However, if you spread your investments across multiple sectors, like technology, healthcare, and finance, or buy exchange-traded funds that hold a basket of stocks, you reduce the risk of losing everything. Diversification helps balance the risk and rewards of investing, as some stocks may go up while others go down. A well-diversified portfolio can provide more consistent returns and reduce the impact of any single investment underperforming. Tip 5. Learn about ETFs and mutual funds. If you're not comfortable picking individual stocks, you may want to consider investing in exchange-traded funds or mutual funds. These investment vehicles allow you to invest in a variety of stocks at once, which helps with diversification. Both ETFs and mutual funds are ideal for beginners because they allow you to invest in a broad range of assets without having to research individual stocks. They provide built-in diversification and are managed by professionals who handle the investment decisions for you. Tip 4. Understand the concept of compounding. One of the most powerful concepts in investing is compound interest. Compound interest is the process by which you earn interest on your original investment, as well as the interest that has already been added to your account. Over time, this effect can significantly boost your investment growth. Let's say you invest $1,000 in the stock market and earn an average annual return of 8%. After 1 year, you would have $1,080. The next year, you earn interest on the $1,080, not just the original $1,000. This compounding effect continues year after year, which is why it's so important to start investing early and be consistent. Tip 3. Set clear financial goals. Clear financial goals are needed before investing in stocks. You investing for retirement? Are you saving for a house? Do you seek short-term income or long-term wealth? Having goals guides your financial strategy. When investing for retirement, you may wish to focus on long-term growth and buy equities with a larger return. Bonds or money market funds may be better short-term investments for stability. Setting specific goals guides your financial plan and keeps you focused and disciplined. It also helps you assess your risk tolerance and investment capacity. Tip 2. Be patient and think long-term. It's not easy to get rich in the stock market. Fast returns may disappoint. Stock market investors that are patient and long-term succeed best. Stock values are volatile, so your investments may lose value. If you're focused on portfolio growth, short-term market volatility won't affect you. Over time, the stock market has produced solid returns, but it takes patience. Do not timing the market or act on short-term swings. Consider investing frequently, diversifying, and giving your investments time to grow. Tip 1. Start investing as soon as possible. The best time to start investing is now. It's easy to procrastinate, but the earlier you start investing, the more you'll benefit from compounding growth. Even if you can only invest a small amount at first, starting early gives your money more time to grow. Starting small is better than waiting until you can invest large amounts. You don't need to wait for the perfect time to invest. There's never a better time than today. Most brokerage accounts allow you to start with as little as $50 or $100, and some even offer fractional shares which let you buy a portion of a stock. By starting now, you set yourself up for financial success in the future. Congratulations, you now have the basics of stock market investing. Remember, investing is a journey, not a destination, and it requires patience, knowledge, and discipline. The key to success in the stock market is understanding the fundamentals and having a clear strategy. What's your biggest takeaway from today's video? Are you ready to take the plunge and start investing, or do you have more questions? Let me know in the comments. I'd love to hear your thoughts. Don't forget to like, share, and subscribe for more beginner-friendly investing tips. Take the first step towards financial freedom today, and I'll see you in the next video.